Apple paid just 0.005% in taxes on some of their profits. Amazon moved billions through Luxembourg to avoid taxes. Google shifted over $75 billion out of Ireland in a single year. These aren't illegal schemes. They're using something called offshore banking, and it's completely legal when done right. Today, we're going to break down exactly how this works, why it's legal, and whether regular people can do it too. So what exactly is offshore banking? Offshore banking is simply keeping your money in a bank outside your home country. That's it. The term offshore comes from the Channel Islands being literally offshore from the UK. But now it just means any foreign bank that gives you financial advantages. Think of it like this. You live in the US, but you open a bank account in Switzerland. That's an offshore account. It works like any regular bank account. You can save money, receive payments, and transfer funds. The difference is, it's subject to different rules and regulations. These accounts aren't just for the super wealthy. They're used by expatriates, international business owners, and even digital nomads who work across different countries. So, why people use offshore banking legally? There are several legitimate reasons why people and companies use offshore banking. First is privacy. Some countries have stronger bank secrecy laws. Your financial information stays more private compared to domestic banks. Second is tax optimization. This is the big one. Different countries have different tax rates. Some places charge zero corporate tax. Others have very low rates. Companies can legally structure their business to take advantage of these differences. Third is protection. If your home country has political or economic problems, having money elsewhere protects you. Think about people in countries with unstable currencies or governments. The key word here is legally. All of this is above board when done properly. So, where do people go for offshore banking? The British Virgin Islands handles about 7% of the world's corporate tax optimization. The Cayman Islands takes another 7%. Then you have Bermuda, Switzerland, Singapore, and Hong Kong. Each place offers different advantages. Switzerland is known for stability and client privacy, though they've had to become more transparent recently. The Cayman Islands offers zero corporate and personal income taxes. No capital gains tax either. Singapore has what's called a territorial tax system. You only pay tax on income earned in Singapore. Panama uses the US dollar and has a similar setup. These aren't secret locations. They openly advertise their tax advantages to attract international business. Let's look at how the big tech companies actually use this system. Apple used something called the double Irish with a Dutch sandwich. Sounds complicated, but it's actually pretty simple. They set up companies in Ireland and the Netherlands to move profits to Bermuda, where they paid almost no taxes. This worked for years until the EU caught up with them. In 2024, Apple had to pay Ireland 13 billion euros in back taxes. The EU said Ireland gave Apple illegal tax advantages. Amazon did something similar in Luxembourg. They channeled European sales through Luxembourg to pay lower taxes. The EU investigated, and Amazon had to change their structure in 2024. Now they pay taxes in the countries where they actually make sales. These companies weren't breaking the law. They were using legal structures that different countries offered to attract business. In 2016, something called the Panama Papers leaked. These were 11.5 million documents from a law firm in Panama. They showed how wealthy people and politicians used offshore companies. The papers named 12 world leaders and 128 public officials. Iceland's prime minister actually resigned because of what came out. There were also celebrities, business people, and even some criminal activity. Then, in 2017, the Paradise Papers leaked. Another 13.4 million documents. These showed more offshore arrangements. We learned that Apple used Jersey to protect their low-tax setup. Formula One driver Lewis Hamilton avoided tax on his private jet. Even the Queen's private estate had offshore investments. Here's the important part, though. Most of what these papers revealed wasn't illegal. Offshore companies are generally legal. The problem comes when people don't report them properly or use them to hide criminal activity. So what's the difference between legal and illegal offshore banking? Legal offshore banking means you're following all the rules in both countries. You report your accounts to your home country's tax authorities. You pay the taxes you owe. You use the accounts for legitimate business purposes. Illegal use is when you hide money to avoid taxes you legally owe, or when you use offshore accounts to launder money from criminal activities, or when you simply don't report the accounts when you're supposed to. Tax avoidance versus tax evasion is the key distinction. Avoidance means legally minimizing your taxes within the rules. Evasion means illegally hiding income or not paying taxes you owe. For example, A U.S. company setting up a subsidiary in Ireland to take advantage of lower corporate tax rates is legal avoidance. A U.S. citizen hiding money in a Swiss account and not reporting it to the IRS is illegal evasion. The line isn't always clear, but reporting requirements usually are. Now the question is, can regular people do this? You don't have to be Apple or Amazon to use offshore banking. Regular people can do it too, but there are costs and rules involved. Opening an offshore account can cost anywhere from $1,000 in places like Belize to over $100,000 in the Cayman Islands for traditional banks. Switzerland often requires deposits of $10,000 to over $1 million. Who benefits most? Digital nomads who earn income in multiple countries. Expatriates living abroad who need to manage different currencies. But here's what you need to know about the rules. U.S. taxpayers have to report offshore accounts if they exceed certain amounts. The threshold is $10,000 for one type of reporting and can be $50,000 to $200,000 for another, depending on your situation. The penalties for not reporting are severe. Non-willful failures can cost over $15,000. Willful violations can cost 50% of your account balance or over $150,000, whichever is higher. So yes, regular people can use offshore banking legally, but you better follow the rules exactly. Now you might be thinking about the government point of view on this, so governments aren't just sitting back and watching tax revenue disappear. The US created something called FATCA in 2010. This forces foreign banks to report information about American account holders to the IRS. Banks that don't comply face a 30% tax on certain US payments. Most banks chose to comply rather than lose access to the US financial system. Then there's the Common Reporting Standard, or CRS. Over 120 countries signed agreements to automatically share information about each other's citizens' offshore accounts. If you're a German citizen with a Singapore bank account, Singapore reports that information to Germany automatically. Countries are also working together on something called base erosion and profit shifting, or BEPS. This tries to make sure companies pay taxes where they actually do business, not just where they can get the lowest rate. The result is that offshore banking is becoming much more transparent. The days of secret Swiss bank accounts are largely over. Let's talk about the scale of all this. Researchers estimate that $21 to $32 trillion in financial assets are held offshore. That's trillion with a T. The Tax Justice Network says this costs governments $427 billion in lost tax revenue every year. A recent study of 342 large U.S. corporations found they paid an average effective tax rate of just 14.1%. That's well below the official 21% rate. 87 of these companies paid single-digit tax rates or less. 23 corporations paid zero federal tax over 5 years. These companies claimed $275 billion in total tax subsidies. Meanwhile, global cross-border bank credit reached $32.6 trillion at the end of 2024. These aren't small numbers. This system affects government budgets and public services around the world. So here's what we've learned. Offshore banking is a legal financial tool when used properly. It's not just for criminals or the ultra-wealthy. It's used by multinational corporations, international business owners, expatriates, and even regular people who qualify. The key is following the rules. What do you think? Should this system exist? Is it fair that some can legally avoid taxes while others can't? Let me know in the comments below. And if you found this breakdown helpful, hit that subscribe button. We break down complex financial topics like this every week. Thanks for watching.